Good afternoon, everyone. Welcome to our Q&A session this Tuesday on the Paycheck Protection Program. As a reminder, we do these twice a week to give you an opportunity to get up to date on any changes to the program, as well as have an opportunity to ask questions to our internal forgiveness expert here, our Senior Director of Finance, Justin Ridgely. I am Meredith Wood, our head of marketing here at Fundera, and we've been doing these for quite a while now, and I've really enjoyed this time together, and just want to emphasize a couple of things, which is because a lot of forgiveness questions can be very technical, we are trying to take as many of the questions as we can beforehand. So if you can just keep an eye out on any of the webinar communication, you'll find places you can insert any questions you may have, as well as you do have the opportunity to ask questions in the Q&A box during this time. You can reach out anytime to us on Twitter on support@fundera.com if you have questions we weren't able to get to. And the only other thing I wanted to add is we have spun up a new webinar series focused on SBA 7A loans, which is another type of funding you can seek right now at a moment when there are generally less credit options. There will be more information on that program as well over email, so keep an eye out for that. I will hand it over to Justin to go through any updates we may have, and we'll jump right into questions.
Sure, thanks, Meredith. So since I gave, the last webinar, which was last Thursday, there was no real updates, legislatively or whatnot. The House passed their version of the bill last week, which pushed, 8 weeks to 24 weeks. Pushed the 75% threshold to 60%, and then bumped back the 6/30 date to 12/31. But that bill has not been passed yet in the Senate. It was under discussion yesterday, and one of the main points of contention is that Marco Rubio brought up, will the Treasury Department interpret this 60% change to mean that if you achieve under 60% for payroll costs, will you get 0% forgiveness? And so they're still waiting on that, and the bill is kind of stuck in the Senate right now. Hopefully, it will get passed maybe today as is if Treasury clarifies, or they'll need to write kind of an amended bill, send that back to the House. House passes it, goes to President Trump to sign. So no new real substantive updates there besides that. So Meredith, I think we can jump right into Q&A and try to answer as many questions as possible.
Awesome. So we've gotten this in a couple places to start off. What is the deadline to file for forgiveness? Is there a deadline to file for forgiveness?
There's not a deadline to file for forgiveness. It's just that after 6 months of receiving your loan, you're expected to start making interest and principal payments on that loan. So if you wait, too long, you'll start to have to pay on the loan. There is a provision as part of this new House bill that basically says, until you receive a decision on forgiveness or this 12/31 date, essentially, like you won't have to pay anything before then, which means that even if you got your loan in, say, early May, and you're getting to that 12/31 date and you file for forgiveness on 1/2/2021, and then there's 60 days for the bank to get back to you, you still wouldn't have to pay anything till after that. So that is something kind of being addressed, but right now, forgiveness is kind of on the borrower, and obviously you want to get that forgiveness as soon as possible. So one, what's going to be forgiven and you can plan accordingly, and two, just so that you can kind of know what then you have to pay interest payments on going forward, or verify if there's nothing there.
Okay. Great. If you wanted to, could you spend 100% of your loan on payroll only?
Yes, that's certainly allowed. To get 100% forgiveness, you have to meet the 75% minimum payroll spend threshold, but you can't spend it all on payroll, even if when the program was designed, the 2.5 times average monthly payroll was meant to potentially include other expenses. But there's basically been an emphasis on the point of the program is for paycheck protection, and you certainly won't go wrong by spending 100% of it on payroll. I think especially if you take this program and lengthen it from 8 weeks to either 16 or 24 weeks, then I think, we would see a far higher percentage of businesses spend 100% on payroll, because it was 2.5 times, monthly payroll. And if you had, say, 4 months or even 6 months to spend it, then you can obviously spend all of it on payroll, no problem, most likely.
Awesome. And is telephone considered a part of utilities in the expense category?
It is if it's used for, it's a business telephone. Either, most obvious example is a business telephone, like a landline in your office. If you're a business that has employees where, they have a cell phone that's paid for by the business, that would also fall under that telephone portion probably. I think, if you're someone who's never had your telephone paid, or never paid for your employees' telephone bills, and then all of a sudden you pay for them, that might be allowed if that's your policy going forward and not just during PPP. But, I think if it is a business expense, that would be included. It hasn't been specifically addressed beyond just telephone, but I think those are reasonable assumptions.
Great. You've used the words safe harbor quite a bit throughout the various webinars. Can you explain more what that means?
Sure. So the term safe harbor is somewhat literal and is a term that is used a lot in sort of punitive financial regulations. And basically what it means is if, you find yourself in a situation where you may be eligible for some sort of penalty, you can do something generally before a date and then achieve a safe harbor, which is a literal, comparison to a ship finding a safe harbor in a storm, where it comes from. But what it means is essentially like, okay, in this case, I have reduced the amount of full-time equivalents from the reference period to the current period, and to avoid having my forgiveness potentially negatively impacted, I must restore my full-time equivalent employees before this safe harbor date, meaning that I've achieved this safe harbor and kind of brought myself back from receiving kind of a negative penalty. And so that's all that means. It's used, a lot in financial transactions and things of that nature. It's kind of an odd term. It just means kind of the date or the action you have to do to avoid punishment.
Great. If you haven't returned your PPP funds, can you still reapply and be approved again?
This is a question that I've not been able to find an answer to, and have researched it a little bit, and I haven't specifically heard anyone at the SBA or Treasury make a comment on this. I think if you've already returned it to your bank, your best bet is to call the bank, and maybe they could, they have a way to reissue it to you without like canceling the loan on the SBA side of things. And maybe they could do that. I think if it's more like you want to return a loan because you realize you could get more money based on a better calculation, then that may be harder. But again, I think the only way you can know is talk to your bank. I've not heard of anyone successfully doing this, and I'm not sure if you have, one SBA E-Tran number for your first loan, if you could. I don't think you could get a second one unless there was maybe some way to negate the first one. So I'm sorry I don't have a better answer for that one. It's a bit unclear. It's something that's starting to come up more and more, I think, as the rules around, what the standard on which loans would be judged under. Like in the last interim rule, for instance, the SBA has now said that you'll be judged under the standard under which you applied, not, increasingly tight rules that were kind of implemented later. So I think there are some people that may have returned them and would like to redraw or can potentially get a bigger amount. So hopefully we'll hear some guidance on that soon.
Great. The other thing I would add to that, Justin, is for whomever you receive funds from initially, you could reach out to them and see if they've released your E-Tran number. I know that when there were people who were applying for multiple loans, or I should say not multiple loans, but with multiple lenders, Perhaps they got approved through two lenders and they wanted to work with one over another for whatever reason. The advice was to go to the other lender who potentially had an e-tron number pulled for you and ask them to release that. So that might be something to consider. Again, we're doing our best here with this particular question as we don't have a definitive answer, but that's where I would start if I were in your shoes. So Justin, I think this next question has become our most popular one, but I'm still going to ask it because it's a good one, which is particularly in the case of independent contractors, which I think also applies to sole props, people whose payroll is just obviously not traditional payroll.
Yeah.
How does forgiveness work? How do they prove this?
Yeah, so if you're, someone that is your business as a sole proprietorship, single member LLC, or maybe a couple other instances, an S corporation, it's slightly different than, if you're running it as, multiple employees, and you have to think about the differences. The main difference is that, if you're someone that's looking at I think it was line 31 on your 1040 Schedule C to determine what your loan amount was, then, that was how your loan is calculated based off of your net income there. And, I think most of the questions then come to how do you prove that you're paying yourself out if if you file this way and if you run your business this way. What I've touched on in previous webinars is, a couple of strategies that, by the way, aren't definitive and don't come as guidance from the SBA, but I think are, could work. Is one, you could set yourself up a separate bank account and each month transfer money, or every 2 weeks transfer money to yourself as if you would normally pay yourself. Just so there is just trying to create a paper trail of this was my PPP account. These transactions, on a PDF you could export for the time period later, were my payroll transactions, to myself. If you've already started or you've already kind of gone past that point where you're, say, a month into your covered period and you haven't done that yet, then you can still do that. It just won't be complete. And then I think you're better off, creating some sort of ledger if you don't already have one, that you maybe use for your accounting, that then you add up, like at the end of the year to file your taxes. I would create some sort of ledger that can show, journal entries or whatnot, whether you use accounting software like QuickBooks or Xero, or just, some sort of Excel spreadsheet even, but you'll need to keep a record of these payments. And I think, we'll probably find out more later on what exactly will be acceptable for banks when they start processing more forgiveness applications. But for now, I think it's all about creating a paper trail. I think the other point I want to talk about is what can you pay yourself, or how much can you pay yourself? For owner employees, in the last guidance from the SBA, it was specifically said that, you can pay yourself the minimum, meaning the lower of either of these two amounts. One, $100,000 a year annualized, which is $15,385, or the average 8-week pay you earned in 2019. So unfortunately, if you showed on your 2019 taxes and what you used to get your loan that you made only $88,000, for instance, you will have to take 8 weeks equivalent of that, and that's the most you can pay yourself during PPP. If you made over $100,000 in 2019, that's what you used for your loan, then you are allowed to pay yourself only the equivalent of $100,000 a year, which is $15,385. So that's kind of the provision that is kind of sucks actually for, business owners, sole proprietors who earned less than $100,000 in 2019, but were earning more than that, so far in 2020. So, that specific case, you won't be able to pay yourself what you were earning just prior to the pandemic. So that's that. I'm going to pause there. I think, we can always go into that more, but I think it's all about creating a paper trail and just making sure you don't pay yourself too much, mostly.
Awesome. So we have a participant who has part-time employees that have reduced hours and their period starts on May 25th. When will they have to resume previously scheduled hours in order to qualify for forgiveness?
So assuming there were no other changes to the employees on payroll, meaning there were no other like full-time equivalent numbers that changed, and you just drop some people down to hours, and then are wondering when you have to bring them back up to full-time hours. You have to do that by June 30th, as it stands right now, and this will let you achieve that mythical safe harbor that I've talked about, and not be penalized, on your forgiveness amount for not having the same full-time equivalents as you did. But it's a bit more complicated calculation where you have to compare. You're not comparing to the period like if your period starts May 25th, you're not comparing to May 24th. You're comparing to either the first 2 months of 2020 or like February, I think, to June 2019. So you may be fine even without doing that. It's hard to say without knowing the specifics of this case, but generally you have to re-establish, full-time equivalents or salary or wage rates by June 30th.
Okay. Is it true that the payroll protection program can now be used for other expenses on top of payroll and utilities?
So it can be used for a few other things, not many, besides payroll and utilities. I'm gonna move to the slide real quick. Hold on one moment. So beyond payroll and utilities, which by the way, payroll consists of a few things, cash compensation, plus a few other things, employer paid health insurance, retirement contributions, state and local sales, or state and local taxes. But also, in addition to utilities, you can pay rent, mortgage interest payments, or your EIDL will be refinanced as well.
Justin, I was having a little trouble hearing you towards the end there, as a heads up.
Okay, sorry about that. Yeah,
There we
just
go.
mortgage payment, interest, rent payments, and utilities are the main non-payroll costs.
Awesome. Do 401k and IRA contributions count as part of payroll costs?
They do if they are paid by the employer, meaning this excludes any pre or after tax contributions by employees. So, if you're doing a 401k match program and whatever contribution the employer is matching, that counts. But what the employee is themselves contributing does not count.
Okay. Is there a requirement that besides using the PPP money in 8 weeks, or maybe 12 if it gets extended, that you have to stay open for any certain period of time? Like, what happens if something's beyond your control?
I haven't heard of this specific question before. I'd have to go back and read the whole 26-page guidance note on what happens if a business is wound down in the time period. So I'm gonna have to say I don't know on that one. I don't think generally the guidance for anything has been if something is out of your control, you'll be held liable. But again, I'm not sure. I've never looked into that specific case. Sorry.
Okay. Can the payroll covered period start the date of the first payroll after the loan is received versus when you get it?
Yes. So to revisit this concept of the covered period. So right now, ignoring what the covered period might get changed to in terms of its length, it's 8 weeks. The 8 weeks you can either start on the day that you receive your loan funds, or if you run payroll every 2 weeks or more frequently, then you have the option to use an alternative covered period, which starts then on the date of your next payroll period, like start after you receive the funds. So an example in the first case is you received the funds on May 10th. That's the start of your 8 weeks. And by 8 weeks, we actually need 56 days. It does not go, May 10th to July 10th. It would actually be, I think, a little earlier in July. I don't have a calendar out, but it'd be 56 days from May 10th. Now, if I said, okay, I pay payroll every 2 weeks, and I actually want to start this covered period on the day after that payroll the first day of the next payroll cycle, which would be May 16th. Then you could run 8 weeks from May 16th, and that would equal, 4 even payroll periods. You do have that option, and the only real consequence of that is you may not be able to take advantage of kind of a gray area of, if you start it in between pay cycles, you may be able to kind of squeeze in the previous payroll kind of before the covered period and squeeze in the ending payroll, which covers longer than the period. It's a little unclear exactly how that works, but I think generally it'd be easier from a paperwork perspective and easier from just an application perspective to align it, with a bi-monthly payroll cycle.
Got it. We have a participant who's a sole proprietor and receives their compensation in the form of commission.
Mhm.
And they haven't had a commission check since October 2019. And how would they handle this on the forgiveness form?
So I assume, okay, on the forgiveness form, I'm going to assume this person has a loan already, which means the only thing that really matters, or there's a couple things that matter. One, you can pay yourself out based on, what you earned in 2019 then. So the lesser of that $100,000 or $15,385 amount, or an 8-week average payroll amount for what you got in 2019. If you haven't received anything since then in terms of paychecks, that doesn't affect forgiveness in terms of what you can pay yourself out. It only affects that from the back end where it affects what you earned. However, if you're looking at comparing like the potential reduction based on like wage reduction, that's not gonna be impacted here also because you're an owner employee. So I don't think this really has any impact on what you can pay yourself. It's a bit of an odd, I guess, way to phrase it, since it's not really, forgiveness isn't really focused on what you're currently earning. It's focused on what you're currently spending the PPP funds you've already received on. And I think if you're not earning now, this is exactly what the PPP funds are intended to help you relieve. I hope that answered the question.
Yeah. So we have somebody who had an employee who went out on maternity leave last month. So they're not currently on payroll, but was included in the full-time employee count prior when they completed their PPP application. How does this impact their full-time employee count for loan forgiveness?
So if they're on any, if you're paying them normally and they're on a normal pay cycle, and if you see on the slide that I have up, then this leave is considered part of your gross salary and shouldn't impact you from this payment perspective. However, I think what the question is asking is, will I be dinged on the full-time equivalent calculation? The answer is, if this person comes back before then you would be fine no matter what. And I think the way the guidance is written now, it's a little ambiguous, but I would expect or hope for clarification that someone who's on maternity leave or paternity leave should not be counted against you in terms of reconciling, that full-time equivalent numbers because they were working full-time and they're not presently. I don't know if that's I don't think it's specifically covered in the guidance right now, but judging by the fact that it was called out in this gross salary section, I would anticipate that you would end up being fined there. You can't control if someone has a child and goes on leave, right during the threshold period, that safe harbor date, right?
Mm. And if we have a business who implemented payroll reductions as part of COVID, are they able to use some of the PPP loan to restore salaries and even pay employees back for the lost salary and still have those payments be part of the 75% forgiveness requirement?
On the first part of that, most definitely yes. The goal of the program, is paycheck protection. And if you had to reduce salaries or hourly wages, before you received your PPP loan, and now you want to bring them back up to the prior level, that is most definitely the point. and most definitely allowed. In terms of paying back pay for wages that were missed, prior to receiving the loan, there hasn't been any specific guidance on like writing it insofar as you may pay back pay in those words or something like that. But there is the language that says you may pay a bonus. And so if you were to say, this is my bonus to make up for the wages that were missed prior to the PPP program, and I'm paying it during my covered period, then as it's written right now, that is allowed.
Great. And regarding the employer portion of retirement benefits, do we know what documentation is needed to provide to support this?
One moment. Let me just see what we have here. Okay. So right here in the middle of this slide that I'm showing on the screen is just what is in the actual application form. As you can tell, this is the verbatim, this verbatim text here is not super helpful. So in terms of, what you pay or documenting what you paid, you'll probably receive some sort of bill or, some sort of invoice or tracking, page from your retirement account, I guess, processor or whoever, your custodian, showing what you owe. And I think that, whatever format you receive the amount of what you owe, to these employee retirement accounts as part of your program is what you should provide. I think oftentimes, we've also seen on some payroll processor reports, this is included, some not, depending on what you input or who manages your retirement. But this is all the official guidance that we've received. So I would say whatever documents you have that best highlight what you've paid, maybe supplemented by bank statements showing that actual outflow of cash to those providers. I think that would be best.
Awesome. So we have a question in chat, which I'm actually happy to take, which is about applying for the PPP loan itself. In this case, this person is a sole proprietor and they have one full-time employee. Is the PPP loan calculation based on line 31 of the Schedule C or line 31 Schedule C plus the payroll spent on employee? To answer your question, it is the latter. It is the line 31 Schedule C plus payroll spent on the employee. And I would just say you obviously need to be able to verify the payroll for that employee, which is best usually in the form of a 941 or a 940, as well as anything you may have from a payroll service provider if you do happen to have that. So be prepared for that when you're going through the application. W-3s would also be possible, so something to consider there. And with 1 minute left, Justin, one more question. So in the possibility that they were able to move forward and there was an extension put in place for 24 weeks, does that mean that the businesses are not required to rehire or start payroll immediately after the receipt of funds?
So it definitely could mean that. And I think that that is kind of the point for some businesses anyway. Part of the lobbying that was done to get this changed was by the restaurant industry saying, listen, there are plenty of areas where we cannot open up. So if we are expected to use this money in a time when we're not open, we are essentially paying employees who we could have let go and they could collect unemployment. And then when we open, we could pay them using PPP funds. But if we have to use it in 8 weeks, that's not what we'll do. We'll basically pay them for doing no work or not be able to spend it. So the point is that, that was kind of the reason for, this lengthening potentially of the period. So in that case, yeah, if you took PPP on, June 1st and your normal 8-week period would end, around August 1st there, at the end of July, but now it's extended, from 8 weeks to 24 weeks, and you have 4 more months to use it, then yeah, you could potentially wait until July or August, spend it in 3 months and get the whole amount forgiven. And especially if you had, if you had like laid off people or furloughed people and then rehired them back at that time and met the comparison period, early January or 2019, then yeah, you would be fine to do that. And I think the idea why the law that the it's technically called a resolution passed by the House last week, not a law, because it's not fully signed yet. It was called the PPP Flexibility Act, and I think the purpose is to give more flexibility to better align your funds with your business needs. And so that would be something that, while it doesn't always insulate employees' paychecks in the very near term, might be better for long-term business survival, which should help the economy more in the long run.
Wonderful. Awesome. Thank you so much, Justin. This is incredibly helpful, and appreciate that you're able to get so specific with some of these questions. To everyone who's able to join us, we are hopefully you're able to join us again on Thursday if you have any more questions that we can be helpful with, as well as who knows what updates we may be able to provide during that time. But if you can't wait until Thursday, again, you can find us on Support@ or on Twitter. And keep an eye out for a recording and slides from this conversation, as well as information on other webinars we are hosting. Thank you, Justin. We appreciate you taking the time, and I hope everybody has a wonderful week. Thank you so much.